Hey traders, in this video I want to talk about quiet markets. Stay tuned. Hey guys, warm welcome to you. So, quiet market today. Made one trade, but the market's just sitting there doing nothing. So I'm kind of sitting here reading a book, which is, to be honest, a tough read. It's I've recommended it before to people, and people have gone, it's a tough read, and I agree. It's an old book. It's been reprinted. It's called Studies in Tape Reading by Wyckoff, aka Rollo Tape. And yeah, its first edition was printed back in, 1920 something. I'm trying to find when it was here. But anyway, a long time ago, reprinted now, 2006, 2007. Anyway, I was reading an article here, well not an article, an extract here, which I'll read for you now, about quiet markets. A market which swings within a radius of a couple of points cannot be said to have a trend, and is a good one for the tape reader to avoid. The reason is, unless he catches the extremes of the little swings, he cannot pay commissions, take occasional losses and come out ahead. No yacht can win in a dead calm, as it costs him nearly half a point to trade. Each risk should contain a probable 2 to 5 points profit, or it is not justified. I think the key there is no yachts can win in the dead calm. Now, we are in a more fortunate position now because the commissions are much, much cheaper. We're paying 0.6 on Euro USD, 0.4 or 1 on your DAX and your FTSE, 1 on Dow, super low, and that's probably going to be here to stay. So we can cover commissions, of course, not as challenging as it was back in those days, but a quiet market still is the same principle, guys. This market now is super quiet. So you end up trying to, and this is really the day trader's nemesis, because this encourages us to overtrade. One of the key things I'd always say to any day trader is make sure you have a very, very strict plan to step away and not trade when the market goes quiet. Because when it goes quiet, if it sucks you in, then you're doomed. It kind of calls you in, you see things, your chart gets zoomed in, you see little moves, you think you can read it better than you can. There's not enough volume to see the shift if you're a pure price action trader. The charts and the patterns don't tend to work because it's quieter. Again, you need the volume for many patterns to work. And then someone might argue, well, mean reversion works very well in a range bound environment. You're right, it does. That's a much better way of trading it. However, you have no room for error, because as the market starts to extend, you start to think, that's great, I'll put a little short on for a pull back in. You place the short, it extends a bit more, you place a short. Before you know it, you're risking double what your reward is, and you're in the position you don't want to be in. And then it might start to break out slowly and drift up, and it's very difficult to spot that, because in normal conditions you'd be out because you'd see the spike above your stop, bang, you're out, or you'd see it spike, you'd see the price action change. Because it's so slow, then the market changes condition very slowly, and it's almost like the old boiling frog in water, a frog in boiling water analogy. You don't see it until it's way too late and you're in too deep. So, my advice is, what I do, again, you obviously operate your trading business under your own decisions, of course, because that's how we develop better as traders anyway. But from my perspective, avoiding quiet markets is a essential, absolutely essential skill to have as a day trader. So what you can do is you can start to bracket your highs, you can bracket your lows, you can set alerts on, you can walk away, you've got your phone, you get alerts to your phone, you can sit here, you can read trading books like I sometimes do, start to jot down some ideas on a pad, go out and do something else. There's always something that you can do. And the argument that often people have with trading is, but I'm not making progress unless I'm making trades, because if I don't make trades, I don't make money, and I want to make money. And that's reasonably logical. But the argument that I would put up against that is, listen, the real progress in trading is made in the study. It's made writing bits down, studying yourself, studying the markets, doing other things that then create value when you are trading. There's no value to scalping or trying to scalp quiet markets. They just drain you. They drain your energy, so you're not prepared for maybe an afternoon move. You're not prepared for a real active day tomorrow. You're not prepared for anything. And not to say the damage it potentially does to your P&L. That's a waste of time that you could be doing, spending, studying yourself, studying the markets, printing off some charts, doing other stuff. So keep clear of quiet markets, guys. I don't think people talk about this enough because it's not as sexy, right? So you just don't trade in quite well. Yeah, it's not that great. Look, give me the setups, give me the stuff that's going to make me the money. But actually, at the end of the quarter, if you reduce the amount of times you got caught up in chop, or you start getting involved in these quiet markets, your P&L will be way better anyway. And so, yes, it's not a sexy thing to talk about. Yes, it's not super exciting. If you can find a way, whatever works for you, of avoiding trading in quiet markets, whether you're a swing trader, whether you're a day trader, then I would bet that will significantly affect your bottom line over the long run. Whatever you're doing, guys, take care and keep away from those choppy markets. They're deadly. Bye-bye.